Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is John Mowrey, Chief Investment Officer with NFJ Investment Group. John, it's great to have you with us. Welcome to Trade Talks.
Hi, thank you.
Given the history of high beta stocks outperforming stocks with lower volatility off market bottoms, what do you continue to favor at this point?
Yeah, it's a great question. So there's a couple things that we have our eye on. One are the most cyclical and the highest beta names. These have massively outperformed since the bottom of the market, and that's to be expected given what's occurred with the vaccine and the stimulus that was put into the economy. But as a consequence, we've seen very stretched valuations. And if you look at the spread between the highest and the lowest beta stocks, we are at the widest spread since March of 2000. So we think that's meaningful, and we think that investors should take heed of that when they're thinking about how they're going to allocate for the back half of the year.
What are your expectations for earnings season with valuations at the levels that they're at now? It really does have to matter.
Yeah, it's another great question. So, couple things. I think that a lot of companies got a free pass coming out of the pandemic. They got a free pass on cutting dividends if they needed to do that. They've also gotten a little bit of a free pass on earnings and expectations, and you've seen a lot of beats. But the road's going to get a little bit windier and a little bit twistier as we move into the back half of the year. We think those companies that have consistently been able to, maintain operating margins, grow their earnings, those are going to be the ones that are going to do better in the back half of the year. And so we think some of the more cyclically oriented companies that can have more volatility in those earnings are going to come under more pressure. So we are biased toward more stable earnings within cyclicals, so higher quality cyclicals, as well as defensive areas. We think defensive areas, maybe not in vogue, a little bit contrarian here, actually are a gift because they're on sale here. And we think given where beta is, the higher quality names and the defensive names look particularly interesting.
So, John, you were talking about dividend growth. How important is dividend growth going to be with the backdrop of inflation? And what are some of your favorite dividend growers, whether it's a specific company or a specific sector that you're looking at?
Yeah, another great question. So dividend growth is a theme that we think has not gotten enough press. If you look at real yields, they are negative. And if you look at where inflation's running relative to treasuries, this is the most negative we've seen the real yield going back over 20 years. So when you think about what the Fed did, they've increased, their balance sheet by roughly 3.8 trillion since the beginning of the year in mortgage-backed securities and in treasuries. And then when you also think about supply chain disruptions, that inflation, it may or may not be transitory, but dividend growth is a theme that is a great way to counter that. So we favor companies that are growing their dividends, and I would say at the margin over just companies that have higher absolute yields. Some of the sectors that have very attractive dividend growth right now, I would point to some of the REITs and some of the specialty REITs like the data centers and the tower REITs. But we also see that within some of the healthcare names. You're seeing very interesting healthcare names that have attractive dividend growth in some of the higher quality industrials and technology names. So we think dividend growth will be a theme for investors. And, if you think about compounding money and compounding, income on yield, we think that's a theme that will move far past the back half of this year.
John, I'm glad you brought up infrastructure and REITs. Let me ask you a question as it relates to housing here, particularly multifamily homes, apartment complexes, and so forth. We know the moratorium on rent is going to be lifted shortly. We know particularly smaller landlords have struggled. They don't have the capital behind them to, stretch this any longer. Are there any areas within the REIT space that could be impacted as a result of the pandemic and loss of cash flow?
Yeah, it's interesting. Some of the apartment REITs have actually done very well so far this year. And if you look at those valuations, those are a bit more stretched. And so at the margin within the REIT universe, residential REITs, I would say, is an area that we've gotten a little less interested. And we would again point to industrial REITs, specialty REITs. I do think there could be some pressure there, and you've seen a lot of re-rating with anticipations of reopening. But keep in mind that I think one of the big mega themes going on right now is housing. And because of the inflationary pressures in the housing market, prices are quite elevated. And as a consequence, it's going to be more difficult for first-time home buyers, even with stimulus, to get into the housing market. So that is going to create an interesting dynamic within the renters market. I think the renters market is going to have structural tailwinds as a consequence of what's going on in the housing market with the prices where they are.
Good point. John, appreciate you being on Trade Talks. Thanks for joining us. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you so much for having me on.